So let's quickly move on to the next session, the first presentation of the day on PE risk for MNC and free zone companies, which will be handled by Mr. Manoj Pandey, who is the CEO and Senior Partner, Direct Tax MBG Corporate Services. Welcome, Mr. Manoj, on stage.
Good morning, friends. I convey thank you to ICAI Abu Dhabi chapter and Khalij Times for giving us an opportunity. So, today I'm going to talk about a permanent establishment risk. And this subject is very relevant and important, for companies who have operations, who are multinational enterprises, or even for companies who are based out of free zones. So this concept is introduced even for free zone entities who can have a presence in a domestic, in a mainland. So in the slides we'll understand what is PE risk, when it is triggered, what are the high business risk models, and what are the key steps one has to take to avoid a permanent establishment. So in a simple terms, or in layman terms, we can understand that a PE risk is triggered for a foreign company even without having a legal entity or a fixed place of business in UAE. So you can understand a foreign company in Japan is doing some business here in UAE. It doesn't have any legal entity, doesn't have any LLC, doesn't have any branch office, rep office. But even in such a scenario, it can be subject to taxes in UAE if a PE risk, if a permanent establishment is formed. When a permanent establishment is formed, this is also an anti-abuse provisions, and tax authorities have a wider power to go back as much as 15 years to create a tax liability. And when a tax liability is created, it's created along with interest and penalties. So we have seen circumstances where, with a PE risk or when a PE is formed, the liabilities are so huge that the entities may have to, forego, they have to pay huge sum of money, and in some cases they can even be blacklisted. Along with the corporate tax risk, we also see other risks. The foreign entities can be subject to, registration under the VAT laws. They can also be subjected to make compliances for the employer's registration, and there can be other associated compliances such as, payment of social security, etc. So you need to understand that for a foreign entity from inbound perspective, there is a risk, and for UAE entity, if it is having a business presence or if it is having sourcing of revenues from other countries, the UAE entity also faces a risk from the other country's perspective. So it is both ways, inbound as well as for outbound. And of course there are reputational risks, because if it is reports are published in public media, then there is a risk for the reputation, and it is also inefficient tax planning if it is not properly managed. When PE is triggered, so PE is triggered, there are broadly 4 cases. One is the fixed place PE. So a fixed place PE is simply speaking that you have a permanent establishment, an office, through which business is wholly or partly carried out. So to give you a simple example, you have a branch office, your office or a workshop, and through which a business is carried on. So there has to be some kind of a degree of permanence. And the second condition is that that place of business should be at the disposal of the enterprise, and through which a business is to be carried on. So this we call it as a fixed place PE or basic PE. So here the instances or cases are defined, and we need to refer to it. Then there could be management PE when the management is situated in another country. And then we have agency PE, where an agent is having a principal role in concluding contracts, signing contracts. And there can be another scenario where a service fee is formed where people are deputed in another country in JVs or wholly owned subsidiary to carry out business operation. So these are the circumstances when a tax authorities can create a PE for a foreign company. Now, how is this PE regulated? So this is regulated two ways. One is that each country, through their local laws, they define when a PE shall be formed. So the definition says gives circumstances when it will be formed. It also gives exclusions when it will not be regarded as a PE. There are international tax treaties, and those tax treaties are prepared on the concept of the OECD. So OECD model, more than 3,000 tax treaties are based out of this OECD model, and then we have UN model also. So there is a definition prescribed under the domestic laws of each countries, and then we have a tax treaties, and most of the countries say that if there is a tax treaty, then tax treaty prevails over the domestic laws. So just to give you a simple example, let us say a UAE entity is sourcing revenue from Qatar, and the same entity is also sourcing revenue from KSA. UAE has a DTA or tax treaty with KSA, but UAE doesn't have a tax treaty with Qatar. So in this case, when I am examining the permanent establishment risk for the UAE entity in KSA, not only I'll have to refer to the domestic laws of KSA, but I'll also refer to the tax treaty to see if there is any beneficial provisions are there in the tax treaty of KSA or not. And if there are beneficial provisions, then I can refer to the tax treaty and I can enjoy those benefits. Whereas in case of Qatar, where there is no tax treaty, I cannot refer to the tax treaty. I'll have to go by the domestic laws of the Qatar. So this is the difference. So for permanent establishment risk purposes, not only we need to refer to the domestic laws of that country, we need to also see whether there is a tax treaty or not. And if that tax treaty is there, then we need to see how the provisions are drafted. So if the tax treaty is defining permanent establishment narrowly, then we should refer to the tax treaty and take the advantage of tax treaty. So from the UAE perspective, if you see, the law defines permanent establishment. We have Article 14 and Cabinet Decision number 56. So the fixed place is defined, and we have management, branch, office, factory, workshop, etc. that we had just listed out previously. There is agency P. So here in UAE we see that there is a lot of agency model. So in each case, agency arrangement has to be looked into, and we need to see how an agent and to what extent the agent is playing a role in the sourcing of revenue from UAE. So whether the agent has a principal role, whether he is signing contracts, or he is habitually securing orders or not, that will determine whether the agent can be regarded as a PE or not. And the law also says that any other form of nexus. So in the cabinet decision, it defines the nexus to say that if a foreign entity has any immovable property in UAE, then a permanent establishment shall be triggered. So this is as per the UAE laws. So from inbound perspective, when you have to see a permanent establishment, you will refer to the domestic laws, and then you will also see that whether there is any tax treaty that UAE has with the other country or not, and accordingly we will see which one is more beneficial. So under the domestic laws as well as under the tax treaty, there are exclusions. So whenever in a multinational enterprise doing cross-border transaction, we have to see that whether your business model, your transaction model can fit into this exclusion or not, and if it fits into this exclusion, then we can also take the advantage and P risk can be avoided. So those exclusions are basically the ones which are preparatory or auxiliary in character. These are not the core business activities, and they have been defined to include the storage facilities or the warehousing or warehousing for purchase or any preparatory or auxiliary entity. And there are anti-fragmentation rule also, which are there under the domestic laws of UAE, and it is also there in the tax treaty, which says that we need to see all these exclusions in totality. And there should not be a case that, foreign entity, they set up separate entities and they, divide these functions in one entity. Let's say in some functions they have put into the liaison office, some functions they put into joint venture or wholly owned subsidiary company, and then they try to mitigate the P exposure. It should not be the case, and tax authorities, they see in totality that whether combining together these activities are exclusive in nature, falling under the exclusion category or not, and then only you can take the benefit. So here again the exclusions are there in the domestic laws and the exclusions are there in the tax treaty. We need to see where we have the wider exclusions, and accordingly we should be going ahead. These are the high business risk models that one has to look into. We have a liaison office. So in a liaison office, we have, in many of our clients' case, we are evaluating their P risk. What we have seen that, the liaison office or the rep office, they are operating in UAE since ages, let's say 20 years, 25 years. So if you see the liaison office or rep office, the purpose is to basically explore the feasibility in a country. So where a liaison office or rep office is operating for more than 20 years, they are employing more than 20 or 30 expats, and then having huge kind of a communication with customers in UAE. There are people, they are carrying, a visiting card which says a sales officer or a director from sales or a person who is representing the parent entity. These all will create a business connection, because the liaison office is not supposed to carry out any kind of a business activity. Their role is limited only to collect information. And if that role is exceeded and that role is proved with the ground reality in terms of existence, in terms of how they carry out their operation, what kind of a records they have in their business premises, all those things can lead to a P risk. And here in UAE, we also need to see that all the employment contracts, they are automatically listed, are also there in the MORE. So tax authorities can have a direct access. So it's not that, you have a different contract for, tax authorities and you have a different contract for MORE and all. So tax authorities, they can easily look into it. They can go back previous years also to extract those contracts and verify if there are any things which could lead to P risk. Same way, dependent agent, here the agency model, all agency contract will have to be re-looked into to see what kind of a powers you have given to the agents. So if the agents have wider powers, and in reality, if they are also employing people, and those people in agent company is under the direct supervision and control of the foreign entity, their appraisals, their termination, their appointments, then this could lead to the agency risk. Employee deputation is another important aspect that has to be looked into. So in a simple term, you can understand a UAE entity deputing, some people, let's say in KSA, for a period of 2 years, 3 years, and where these persons, they are not only actually working for the subsidiary entities, but they are representing the parent entity. So what they are trying to do is even though they are wearing the hat of the subsidiary entity, but they represent the parent entity and they start negotiating and concluding contracts on behalf of parent entity. In such arrangements, the tax authorities, they regard it as a dual employment, and then the foreign entity can be subjected to tax. So all the deputation arrangements outside UAE, inside UAE will have to be re-looked into to see what kind of a role they have, what is the period of deputation, what is the type of deputation, and then based on that, one has to assess the PE risk for the foreign entity. The EPC business is again a very complex subject. We have seen a lot of litigation in other countries on this subject. So EPC contracts, there is an offshore portion, there is an onshore portion. In some cases, these contracts are turnkey contracts where you cannot segregate the offshore and onshore, and it becomes very difficult for the taxpayer to substantiate that the offshore portion has no nexus with the onshore. So in such cases, even the offshore suppliers could be subject to tax in UAE. In the same way, if you are doing the offshore supplies from UAE, it can be subject to tax in the other country. So these are very high risk business model. In all cases, this requires a thorough evaluation, proper planning to avoid any permanent establishment risk. Now, as I said that this is the country, UAE is a unique in this aspect that we have seen free zones in other countries also, but here they have introduced this concept for free zone entity also. The reason is that free zone entity is subject to 0% tax, and the purpose of free zone is basically to export. But if free zone is enjoying 0% tax, but they are sourcing business in mainland or with the help of people or presence in mainland, then a free zone can also be subject to tax in UAE because of their presence in mainland. So for free zone entities, if you want to claim 0% tax, you have to be doubly sure that there is no nexus in the mainland, or the revenue in mainland doesn't have any kind of a nexus with people, their presence in mainland, or their asset, or the same concept that we just discussed for a foreign entity will also apply for a free zone entity vis-a-vis their transactions in the mainland. Another important point for free zone here that we don't have a treaty protection. So for a domestic PE, if a free zone forms a domestic PE, we don't have any tax treaty to resort to. Okay. What happens if a PE? If PE is always bad, or you can say, will there be a risk even just we have a PE? Answer is no. So PE, after having formed a permanent establishment, we need to see what is the revenue that you are sourcing from that country. So there can be a scenario you form a permanent establishment, but there is no revenue. So in that case there is no risk. If there is a revenue, if there is a permanent establishment, if there is a revenue, then we need to see that how much attribution you can have to that country vis-a-vis the functions or the assets or the risk that is there. So the tax authorities, this is again a very litigious, generally tax authorities they say 100% of the revenue belongs to the source country and nothing belongs to the residence country, because here each country would like to have maximum share of their tax revenue. So attribution becomes very complex. And this is something that has so many litigation which has gone even on this subject only, attribution, that how much of profit the source country can keep for the tax purposes. There are no clear guidelines on this, and each and every case has to be looked into from a different perspective on a case-to-case basis. But the guidelines that we follow here is basically the same as what we follow in transfer pricing. We call it as a function, asset and risk analysis. So after reviewing the facts, after seeing the function, the asset and the risk, one has to attribute some revenue or some profit to that entity for permanent establishment, and then you have to offer tax. So tax authorities, as you see that this is something which is anti-abuse provision, the tax authority itself, they find it that you have created a permanent establishment, and when they find it, they almost attribute a very high percentage, and then this goes into litigation. So here our function, asset and risk will be very, very important to substantiate a lower attributions. And then when we have to do the function asset and risk analysis, we have to take the help of the transfer pricing provisions. So just to give you an example, a company which is into trading model, so these could be the possible functions. So functions can be understood to be performed in three simple ways: the pre-sales activity, the post-sales activity, the actual sales activity, and the post-sales activity. So pre-sales activity, who is doing the product planning, ordering, marketing, advertising strategy, warehousing, delivering, debt management, collection, and after sales services. So foreign company, subsidiary company, and in third case we have a permanent establishment. So if you see, in case the attribution will be lower, when the functions are, all the functions are performed in case 1, like product ordering, marketing, warehousing, etc. And second case also the similar function there, but assets deployed is less in this case, subsidiary company agent vis-a-vis foreign company PE, and same way risk is less. So we can say here in subsidiary company agent model, the attribution will be lower vis-a-vis the other case where all the function, the asset and risk are there with the PE. But again, the tax authorities, they can resort to arbitrary method of attribution of profits, and this could be subject matter of litigation that one has to go through. What happens if a P is formed? If a P is formed, then you will be subjected to registration, there will be tax payment and filing, and the tax payment and filing will not only be for that year, it will go to the previous years also, as much as 15 years as per the GAR provisions, and it will also come along with interest and penalties. If in case attribution of profit will have to be done, then attribution of profit will have to be substantiated with the records. So it is not that whatever will say the tax authorities will agree. For each and every claim, we have to prove it with the records. So records are going to be very critical here. And in these cases where there is a permanent establishment risk, where you feel that there is a high risk, especially in case of a high business risk models, one should keep records even for 15 years, because the GAR provisions can be attracted. So where the law normally say that you need to keep a record for 7 years, but here where if I have a high risk business model, you should be keeping record for as much as 15 years to prove that our case is justified. There could be a possibility of VAT, and then there could be other tax compliances. So when we say other tax compliances, there could be withholding tax compliances for the employer, and there could be return filing requirements. So these are the steps that one has to look into if you form a permanent establishment in other country, or for a free zone if it forms it in a mainland. So this is another concept, global minimum tax. This is arising out of BEPS Pillar 2 rules. So here the tax authorities, one way is to tax foreign entities by way of a permanent establishment, and this is the another way where they will be taxing the foreign entities. So here the global minimum tax as such is not introduced, and it is applicable to those entities which are subject to CBCR, or we call it as country by country report, the larger entities whose consolidated revenue is more than 750 million. So simply to understand that an entity in UAE, if it is a parent entity in UAE, and if it is doing business in other countries where there is no tax, or the tax rate is less than 9%, and in those cases the UAE entity can be subjected to pay a top up tax. So the differential of that you will have to pay in UAE, and there could be a different regime for filing and compliance purposes. So this is another way where UAE tax authorities can catch hold of bigger enterprises who have multinational, operations, and they are subjected to country by country report. They can easily track which countries the tax rate is lower than 15%, and they can ask those entities to pay a top up tax. Same way, if an entity here operating in UAE, if it is a part of multinational enterprise whose parent entity's turnover is more than 750 million, we could see a higher tax rate of 15% for those multinational enterprises. But of course, as of now, we cannot say anything because the law says that it will be introduced in due course of time. Till the time it is not introduced, the tax rate will be 9%. So, what are the key takeaways? So, as a CFO or as a tax head, one has to see whether you have operations in multinational, cross border or not. If you have, then you should see that whether there is a permanent establishment risk or not. This is the first step. If this is missed out, then there can be huge tax exposure for you in that country. And now going forward, it's not that tax authorities will issue notice, then only you have to consider this. Even your auditor, for that matter, they can ask you to provide for tax provision. So just to give you a simple example, I am a holding company in UAE, I have operations, I have business in Qatar, I am sourcing business from Qatar. So when your auditor in UAE, they will see your operations or revenue from Qatar, they will ask you to evaluate whether you have a permanent establishment in Qatar or not. If you have a permanent establishment in Qatar, they can ask you to create provisions of 10% tax liability in Qatar. And if you say that you don't have a permanent establishment risk, they will say that what is the basis? What is the basis for you to say that there is no permanent establishment risk? So this can be triggered at first level by the auditor, especially if those auditors happen to be your big fours, they will surely ask this question. And at second level, the tax authorities, they can always issue notice and ask you that why a permanent establishment should not be created for you. So we have to see whether risk is there. If a risk is there, one has to consider alternate business model. So alternate business model could be, it's better to set up an entity there. If you set up an entity, you can claim all expenses. There is no issue on attribution of profits, and compliances can be made from the day one. So you don't face risk of penalties, interest in scenario where there is a high business risk. And profit attribution, of course, will also need to see. So when we say profit attribution, because we need to see the transfer pricing angle, and in transfer pricing, first we need to characterize your entity, like what type of functions you are performing, and accordingly what should be the arm's length remuneration for that entity. And for that, transfer pricing consultant will play a key role to decide what should be the adequate profit attribution. So risk mitigation is extremely important wherever there is a cross-border transaction or entity which is based out of free zone and having some kind of a revenue from mainland entities. With this, I end my presentation. I hope this was useful, and of course we can take questions during the break going forward. Thank you so much.